Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer. Yes, well, I'll just let you have a look at the disclaimer. I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. So we'll just run through what we hope to get through in the next 30 to 40 minutes or so. We'll look at how markets are shaping up currently. It's a busy week ahead, of course, with earnings, a lot of US earnings out, European earnings as well, influencing markets. And then we also have central bank meetings. We've had the Bank of Japan. We'll look at that. We do have the Bank of Canada today, as well as, of course, the ECB tomorrow. And then we have some top tier US data as well to contend with. We've had the PMIs already for the Eurozone. We'll check those out as well before then looking at US GDP, which comes out tomorrow before the Fed's favored inflation gauge, which is US core PCE, the deflator. Just before we get to all of that, first of all, well, the theme, wider theme, we like to touch upon these going forward, and generally we have the sort of geopolitical theme is, of course, around at the moment, of course, with the US primaries going on. Trump, of course, won New Hampshire and now steers directly towards a Republican nomination. Of course, the election isn't until November, but there are thoughts around what will happen if Trump wins the presidency, of course, and starts a second term. So a lot of noise around that. Potentially that's a theme for a bit further out, potentially its effect on the dollar, generally assumed to rise. But stock markets a bumpy ride, but potentially rising as well. That is a sort of wider theme at the moment, along with that geopolitical issue connected with the Red Sea and of course the Middle East, is this rise in global shipping rates. And there are concerns around those rates impacting on inflation at some point. So shipping costs, really, they've surged across multiple global measures, ranging from a global composite to basically regional variations. This one we've got here on the chart is the Drewry World Container Index. That's one such global measure. It's soared about 175% since November. Of course, its rise sort of pales in comparison to what we saw during the pandemic, but certainly it's not insignificant. And just because, of course, we're comparing it to that sort of history-making disruption to supply chains, the most ever witnessed during peacetime was the pandemic jump, but this isn't insignificant, and potentially you can see that US CPI, the blue line, correlates quite nicely and lags it potentially. So just look out for that going forward, and potential stickiness in headline CPI rates across the world, really US especially, impacted by this increase in shipping rates. Otherwise, yes, certainly earnings are in focus at the moment. 76 S&P 500 listed firms are releasing their full year and Q4 earnings this week, really as the season broadens out from just the sort of financial names we have had. Key names this week, of course, we've had General Electric. That was disappointing. Procter & Gamble, better than expected. And then we had, of course, Netflix out overnight. That stock's up over 8% in the aftermarket. Earnings beat basically with strong subscriber growth and optimistic revenue and operating margin forecasts. As I say, a surge 8.6% or so in its shares after hours, and that is helping US stock indices, which are up around 0.4%, I think, at the moment. Certainly Netflix earnings come on the back of a near 40% rally already from just before its last earnings release in October. Price is now tracking below $500, but potentially above that now, although that is still some way off its all-time high around $700 from November 2021. Otherwise, we do have Tesla, of course, that is out tonight. That will no doubt grab the headlines. Its shares have struggled this year compared to other tech giants involved more directly in AI. They've lost 20% of their value actually in the last 14 days or so. And certainly competition from rival electric vehicle makers, especially in China, is a headwind, with BYD actually recently overtaking the company in vehicles sold in the final quarter of last year. Major support that sits around $200 on the Tesla chart and is also the point of last year's rally. So really interesting how Tesla gets on and their hints at delivery of their cars, especially as we're sort of getting to this sort of notion of peak delivery potentially in the near term anyway, of EV cars in general, and Chinese makers pushing into various markets which Tesla has had the top spot in. As for the major indices, if I just grab a chart of firstly the S&P 500, which is here. We've just obviously had this very strong bull run, which is still ongoing. We made the third day in a row. We had an all-time high, closing all-time high in the S&P 500. That's a broad-based index. Although the Dow retreated and underperformed following actually a significant drop in 3M. You can see those 9 consecutive weeks of gains. That was last seen in 2004 actually, and that was just before then we made these all-time highs. Prior high was obviously from January 2022, which you can see there at 48.18. Now closing high from yesterday, 48.64. Really interesting, probably semiconductors really leading these gains. The upbeat outlook from TSMC we had last week, that's a Taiwan-based global chip manufacturing giant. They reported strong results, propelled the sentiment of the semiconductor space in general, and then bullish momentum really into this earnings season in the coming weeks is key, and as well, of course, any persistent anticipation of a March rate cut by the Fed will likely underpin renewed strength for the US equity market. Interesting, of course, that it's results really that are helping and just this narrow sense of 7 to 10 stocks boosting the wider indices at the moment. And as well, actually, ASML, which is the European chip maker, that reported today a big jump in Q4 bookings as the semiconductor market recovers. So even though it did maintain actually a conservative FY 2024 outlook with no change in revenue, that has given a boost to sentiment in general, along with, of course, those Netflix earnings. I should mention, of course, stocks in China and Hong Kong, they did trade higher, again up around over 7%, I think, in a couple of days. Big hopes for a market rescue package. Some skepticism initially, really, because that may help the Hang Seng, but the mainland Shanghai index really dependent on the property sector and any stimulus measures there. But at the moment, the stimulus measures are mooted to be just in the stock market. The Nikkei actually bucked the trend of higher indices, even though it has obviously ramped far higher. The yen trading firm on growing expectations really around the BOJ exiting its ultra loose rate policy. Just back to the S&P then. We do get, of course, next week, next Thursday, huge day for earnings with Amazon, Apple, Google and Meta all reporting, and that is the day after the Fed meeting. So a big few hours there, big couple of days there for risk markets, for the stock markets, as well as markets in general with that Fed meeting as well. Can't say too much technically, really. We're not really overbought. You can see on the weekly, at least, very close to it though, making these all-time highs. You can see, well, we're in the third consecutive week of gains. Actually, I'll leave the Kelton channels on there, and on the daily, you can see just 4 consecutive days of gains now. Third consecutive posting of a record high and just through that 48.18 level, and just looking a touch overbought now on the daily RSI. Nasdaq, similar position, near all-time highs. You can see the weekly, those consecutive weeks of gains, then just a slight pause at the start of this year, actually before then breaking higher to the upside and new all-time record highs. Slightly overbought, so just watch out for some retracement on that. Dow has been underperforming, as we said, popped up yesterday to a new all-time high, but then just pulled back. Sorry, the day before, but just pulled back yesterday, and we could just see that nice breakout, nice consolidation, but very overbought through the Keltner channels at least, and just slightly on the daily RSI. Hopefully you can see all those charts that I've just gone through. That was the Dow, of course. Then we did have the Nasdaq, and then the S&P as well, and those consecutive weeks of gains and the consecutive days of gains as well, but slightly overbought, as I said, on the Dow index. Okay, let's just go just briefly to last week's main data points. We'd just like to review these just to check where we are heading and what happened. Of course, we had the mid-month data dump out of the UK, so we had UK labour and wage data as well as CPI and retail sales. Wage data actually cooled more than expected. Private sector pay growth, that sits at around 6.5% now, down from 7.2% in October, and a peak of over 8%, remembered last summer, so that was encouraging. Steady unemployment at 4.2%, though there are still processing issues with that, so not much attention paid to that really, but it is the idea of slowing wages, some easing in labour market tightness, which should really help dampen broader price pressures going forward, and then potentially pave the way for lower Bank of England rates later this year. Of course, that said, we then got the inflation data for December out the following day, last Wednesday. That came in above expectations, 0.4% month on month, double the market consensus. And then for the annual measure, 4% up from 3.9% and 0.2 above the expected 3.8%. So sticky inflation really, that saw investors really rein in their expectations of Bank of England easing actually. Your core rate was interesting with services inflation, which the Bank of England really focus on that increase as well, 0.1 to 6.4, although it is noticeably much lower than the bank's MPC's forecast at 6.9%. But as I say, reining in of expectations of bank easing, they were back to around 105 basis points, and even now yesterday I think we're below 100 basis points of cuts priced in for 2024. That's down actually from around 170 basis points of cuts at the start of the year. Just interesting reaction after that better than expected CPI data. The FTSE, of course, that sold off 1.5%. Actually, interest rate sensitive real estate sector, that sold off 3.5%. But going forward, I think it's key. Bank of England officials have already signalled that January CPI may be beefed up by higher energy bills, but then after that is what is interesting, and certainly economists expect prices to drop quite sharply on then lower energy bills. Some economists even expecting sub 2% inflation prints as early as April. Yes, so that's inflation today. Just to note, we did get better than expected PMI data, so that was encouraging, and that has given a lift to sterling. If we just pull up the cable chart now, Here, sterling, you can see it's really trapped in a range, sadly, between 126 and 128.28, really. We've been in that for over a month now, but we're still above that 50-day moving average. That's rising, so that's positive. Slight uptick in the RSI as well, but of course, stuck in this range still. The 50-day moving average, that's that blue line, that's at 126.46. And it's just whether then we could beat the sort of recent high at the end of December at 128.28. Okay, let's move now to well, first of all, we'll go to I just should have mentioned this chart actually. So it just shows you the inflation chart anyway. 4% sticky, 5.1% as well. Just pausing this downtrend, this disinflation trend in the UK inflation data. Just before we go to the ECB, actually, I just want to probably go to. Sorry, just bear with me. We'll go to dollar yen actually after the Bank of Japan meeting. And you can see the dollar yen charts here. Yeah, so the Bank of Japan, they kept, of course, all their measures unchanged. That means the policy rate's still at negative 0.1%, 10-year target for yields around 0, with the upper bound at 1% as a reference rate. They did publish a new economic outlook, the bank, with inflation data really widely as expected, unchanged for core inflation, and the 2024 data or projection was revised 0.4% lower to 2.4%, all widely expected. So market reaction initially muted, but it was Governor Ueda's comments which were interesting, more positive on wages and inflation than previous meetings, and he really hinted that wages and prices were heading in the direction of price stability. That really, you can see we did get a drop in dollar yen before then the push up on higher 10-year treasury yields, but really expectations are now only a matter of time for the Bank of Japan to start normalizing policies, especially with those small hints by Governor Ueda. Even though, of course, the Bank of Japan reconfirmed its patient easing stance, the timing, of course, is uncertain, but certainly market bets have increased on an April rate hike after the meeting. And also then that will be when they do release their next set of CPI forecasts, though I should caveat that with the fact that it is in the middle of the wage negotiating shunto season. Certainly, of course, inflation will be the guide, with economists expecting a fall in January, ahead of then a sharp pickup in February. So that will be what the Bank of Japan are watching, and potentially some sort of tweaks to policy in April. So we do have a couple of meetings before that, and probably a bumpy ride in inflation before potentially then after the wage negotiating season, giving more clarity to Governor Ueda and potentially a tweak to policies. Of course, dollar yen, well, that has tumbled as much as, well, 5.6% this month alone, to around that high just yesterday, was it 69? No, a couple of days before, last Friday, 148.80. We're just consolidating just above that 100-day moving average, that is, at 147.50. So potentially, if we can break above 148.80, then looks like bullish consolidation having eased back slightly. But if we do lose probably 147.45 and then 146.97, then potentially we roll back down towards sort of 146. Where are we? 146, just above there, which is the halfway point of this November decline. I think interesting for dollar yen, certainly carry trade investors will potentially increasingly turn to the Swiss franc as their preferred funding currency. The S&B want a weaker currency, and they may be actually the first bank to ease policy, whereas of course the Bank of Japan, they prefer a stronger currency and will potentially be the only G10 central bank to hike rates in the coming months. So just watch out for that as well, being a driver of the yen and dollar yen as well. Okay, let's now go to the ECB meeting. and look forward to that announcement tomorrow. Expectations are again for the ECB to stand pat on all three of its key rates, having held the deposit rate at its current peak of 4% since October. So it would be the third consecutive meeting holding rates. In terms of recent economic developments, we had the HICP Eurozone figure that rose to 2.9% from previous 2.4% amid unfavorable base effects from Germany. Note the uptick is set to be a temporary one, and therefore the disinflationary process is still judged to be in place. Core inflation, that did move lower, that declined in December to 3.4% from 3.6%. On the growth front, well, we've had PMIs today, which were worse than expected. And then we have had, well, a negative GDP print out of Germany as well. All that said, of course, with this sort of stagnation picture in the Eurozone and this slowing trend for inflation, plus, of course, that subdued growth, January probably too soon for the ECB to start its rate cutting cycle. Policymakers probably attempting to dampen expectations for an aggressive path of reductions over the past few weeks. We've heard that recently from multiple ECB officials. President Lagarde last week, she set the tone really for probably what we can expect tomorrow. And at the press conference she holds after the decision last week, she said about market pricing for rate cuts is not helping our fight against inflation if the anticipation is such that they are way too high compared with what's likely to happen. So really the emphasis is on the way too high expectations for nearer term easing. Actually, when asked direct about a summertime cut relative to earlier pricing, she said, I would say it's likely, while going on to stress, of course, that the bank is very data dependent. So just that is probably what is expected. President Lagarde will reiterate the data dependence of the bank, will not want to offer much guidance because of the uncertain nature of possibly sticky inflation due to the Middle East events, the Red Sea events especially, and also then hoping that, of course, the disinflation trend will continue. Markets then have reined in these rate cut bets around 128 basis points or so by year end. That's from sort of above 160 basis points after the last ECB meeting. Surveyed economists, they're probably slightly less hawkish leaning, with the median looking for a rate cut in June and around, only around 100 basis points of cuts this year. So yes, that's the ECB meeting. As I said, we did get flash PMIs out for January earlier today. The composite, as I say, that's a reliable indicator of overall economic performance. That's still sounding the recession alarm for the Eurozone. Tracks below 50 still, even if there was a slight improvement in January, as I said. And there is sort of hopes that there is a sort of tentative bottoming out. As I say, still in stagnation mode, and really key will be these tensions in the Middle East disrupting shipping lanes and delivery times. Manufacturing price pressures, they stayed actually relatively moderate despite those disruptions in the Red Sea, but it was services actually which saw another acceleration actually in the input costs. So slightly different to what was expected in those sort of price elements. And delivery times, really, they have been a good leading indicator, as I said, as I showed you, for goods price inflation going forward. If we just look at the Euro-dollar chart now, it's just a bit messy here, but bear with me 1 second. Yeah, you can see we were just getting support from the black line, which is a 200-day moving average at 108.44. We've seen that a couple of times, so that's a decent level of support. It looks like below that you've got yesterday's low at 108.21. But then below that we have probably, where are we? Probably the halfway point of the October rally, which is at We're just below 108, I will say. If we do lose this 108 sort of 44 region, then 108 the next support level. Otherwise, resistance probably up around 109.21, that 50-day moving average, and then halfway point of the December rally at 109.31. So that is euro dollar ahead of the ECB meeting. Also today we do have the Bank of Canada meeting. Just pull up the dollar CAD chart. Again, no change expected. Rates expected to be held at the current 5%. We do get the full package actually from the Bank of Canada. So we get a statement, we get the monetary policy report, including fresh forecasts, and then we get a press conference and Q&A with Governor Macklem. Forward guidance potentially will be key here. Remember that Macklem, he said in mid-December, so during his pre-holiday speech, that underlying inflationary pressures are easing in much of the economy. Of course, there has been a lot of focus on a couple of the CPI measures, the trimmed mean and the weighted median. They have actually accelerated over the past 2 months. And so, of course, the Bank of Canada targets headline inflation of 2% over the medium term, but uses those trim mean, which is at, just checking, 3.6%. Up to 4.8% in December, and then the weighted median, that was up to 4.7% in December. So the Bank of Canada, as I say, they use these gauges really to assess whether they're on track towards achieving 2% over the medium term, because those gauges really weed out the more volatile components. So we're certainly not there yet. It will be a surprise if we do hear Governor Macklem sounding incrementally probably more dovish. It'd probably be more cautious, if anything, continue to intimate that markets are overly aggressive in pricing near-term rate cuts, as he did in that speech before the holidays, before Christmas, when he said they will want to see clearer evidence through volatile readings that they are durably on track to 2% before easing. As for dollar CAD, well, markets actually, they're pricing around 110 basis points of easing by the Bank of Canada in the next 12 months. Potentially then today's meetings will fail to endorse that. As I said, Macklem may potentially bat against that, push against that, and then that could mean the dollar, CAD finds some support. As for dollar CAD, you can see just trading below the 200-day and 50-day moving average. That's the blue line and the black line there. That's at 134.79 and 134.81. So that probably offers initial resistance. And then you get the halfway point of the November decline at 135.68, just above. Otherwise, support looks like these two lows from Monday and Friday last week, around 134.21 and 134.14. So that's initial level zone of support for dollar CAD. Okay, let's just finally wrap up with a look at the US data. We do get the first estimate of Q4 GDP, which is expected to show 2% growth, easing from that blockbuster Q3 growth of 4.9%. Analyst forecast ranging actually between 1.3 and 2.8%. Really interesting consensus. Really, probably will have to have underestimated momentum in the US economy for the 6th consecutive quarter. So basically, forecasters come into each quarter over this period expecting either contractions or very soft growth, only then to spend the whole quarter revising up their forecasts. And that's shown by the Atlanta Fed GDP Now estimate, which is tracking Q4 growth at 2.4%, so above that 1.92% analyst consensus. That estimate was actually revised up from 2.4 from 2.2. after better than expected retail sales and industrial production last week. And it's notable that there was a large beat in the retail control metric, and that feeds directly into the consumer spending section of GDP. So really interesting whether we just get this 6th consecutive quarter of upward revisions to GDP, that potentially gives a bid to the dollar, although generally it is known now that we have seen that over the past 6 quarters. The Fed median dot plot currently expects real GDP to ease to 1.4% of growth by the end of this year, before picking up slightly through 2025 to 1.8%, just for your guide. So that's GDP tomorrow. We do then get as well as I said, the Fed's favoured inflation gauge, the December PCE report. That's due on Friday. After CPI landed at 0.3% month-on-month in December for headline and core, PCE expected to be a touch softer, 0.2% for both readings. If the data is in line with expectations, then the annual rate of PCE would fall to 2.9% from 3.2%. And then this 3-month and 6-month annualized rates, this is really interesting, of core PCE would fall to 1.5 and 1.9%, so below target effectively. Yes, so a lot of data. We actually get durable goods actually out on Thursday as well, probably posting a decent gain on the back of higher aircraft goods, and we do get those weekly jobless claim numbers actually tomorrow. They've remained very low, with the latest week back down toward the post-pandemic low actually of 182,000 that was set in September 2022. So a lot of data to contend with for or out of the US, potentially better GDP data, but then softer prints in the PC deflator the following day on Friday. As for the DXY, you can see, yeah, we did pop up, looked like we were breaking higher after this consolidation, nice bullish consolidation pattern. We printed up to 103.81 on the dollar index chart, but then couldn't sustain that, toying with the 200-day moving average. That's a 103.48, and then today you can see we're just moving lower, and just below that sort of fib level, 103.88. No, 103.18, sorry. Is it 103.18? 103.88. 103.18 looks like. So yes, those are a couple of levels. The 50-day moving average, that's that blue line of 102.85. Potentially, if we do lose this, then we roll over on the DXY, but a lot of data to contend with, as I say. Okay, we'll wrap it up there. We've gone through quite a lot there quite quickly. Hopefully that's proved of use to you guys. A lot going on, especially with that ECB meeting tomorrow, Bank of Canada meeting shortly, guidance key for Bank of Canada, less so for the ECB meeting, and more about what Lagarde says, probably about data dependency. Of course, any hints at all about rate cuts and timings will be seized upon by markets and may push the euro lower. Take care out there, and we will speak to you in a couple of weeks.